Alright, so we'll look at these. So, first thing we'll look at is the difference between an accrual and a deferral. A deferral means that cash is received or paid and then revenue is earned or the expense is incurred. A deferral would be similar to the instance we looked at before, where rent was paid to the family healthcare company up front. So they received the cash and then recognized the revenue as time went by and the rent was earned. For an accrual, that means that revenue is earned or the expenses incurred and then cash is received or paid, so it's the opposite. So that would be in Joe's lawn service, where he does lawn work in June, recognizes revenue, and then gets his cash paid in July. So again, deferrals, cash is received or paid, and then revenues earned or expenses incurred. An accrual is the opposite. Revenues earned or the expenses incurred, and then cash is received or paid. So let's look at an adjustment for prepaid insurance. So for prepaid insurance, as it's used in what's called expired, we'll reduce prepaid insurance by $1,100 every month, and then we'll recognize insurance expense on our income statement for $1,100 every month. And then we know expenses reduce retained earnings on the balance sheet, so retained earnings is thus reduced by $1,100. Let's look at an adjustment for supplies. So we're told that we used $150 of supplies, and our ending balance would be $90. So if we look at our supplies expense adjustment, we reduce supplies by $150, leaving an ending balance of $90, which is what they tell us it should be. We have insurance supplies expense on our income statement for $150, and now we know supplies reduce retained, or expenses reduce retained earnings by $150. So depreciation. So in the course of business, you buy equipment, it's used to generate revenue over time for your business, and during that time it's depreciated because you use up the equipment. So let's look at an adjustment for depreciation. So we're told that the depreciation on office equipment is $160 per month. Our entry for depreciation always is accumulated depreciation on the asset side of the balance sheet, and then depreciation expense on the income statement, and then expenses reduce retained earnings on the balance sheet. Notice that accumulated depreciation is an asset, but its balance is negative, and that's always going to be the case. So you see cash, accounts receivable, prepaid insurance all have a positive balance. Accumulated depreciation will always have a negative balance because it's what's called a contra asset. So let's look at unearned rent. So on November 1st, we had received $1,800 from ALS for rental of land for 5 months. So we're going to take a look at 1 month of revenue recognition for the 5 months of rent that they paid up front. So we're going to reduce unearned revenue by $360 because 1/5 of that revenue was earned, so that only leaves 4/5 of it unearned, which is $1,440. The other side of our entry, we're going to recognize revenue on our income statement for $360. And then we know that revenue increases retained earnings on our balance sheet. So let's look at wages owed. So we've all had this scenario. We do work in the last couple weeks of June, but payday doesn't fall until the early part of July. From a company's perspective, you did the work in June, so that's when they should recognize the expense, even though they're not writing the check until July to actually pay you. So in this scenario, say $220 of wages not paid is for the month of June, hypothetically. So $220 of work was done by employees, we just haven't cut the paycheck yet. So we're going to increase a liability called wages payable, which is an obligation for us to pay wages in the future. On our income statement, we're going to recognize wages expense of $220, and we know expenses reduce retained earnings on our balance sheet. So now we're going to look at accrued revenue. Accrued revenue means that we did some work for patients for $750. We just haven't been paid cash yet. So we're going to increase our asset called accounts receivable, which is a promise for somebody to pay us in the future. We're going to increase revenue on our income statement because we did the work so we can recognize the revenue. And revenue increases retained earnings on the balance sheet for $750.